Hey everyone, welcome back to Corporate Decoder, the place where we turn confusing corporate reports into something you can actually understand. Today we're diving into a shareholder report, so get ready for some fun facts and maybe a few surprises. It's not always what it funds like. This report covers how well some investments did. Think of it like a report card for your money. We'll break down the key numbers, how the funds performed, and what the people managing the money are thinking. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for even more discussions. First off, this isn't about just one company. This report is from Advisors Preferred Trust, and it includes updates on 3 of their funds: Spectrum Active Advantage Fund, Spectrum Active Advantage Fund, and Spectrum Unconstrained Fund. Each of these funds has a different strategy for where they put your money, so let's get into each of them. The period covered is mostly for the 6 months ending in March of 2025. Let's start with the Spectrum Active Advantage Fund. The report card tells us how it did from October of 2024 to March of 2025. If you want more information, you can check out the website or call them, but we are getting right into it. So how much did it cost to have them manage your money for those 6 months? For every $10,000 you invested, it cost you $87. That's like paying 1.78% of your investment. That number is annualized, meaning they've turned the 6-month cost into what it would be for a full year. Now, for the important part, how did the fund actually perform? Well, during this time, the Spectrum Active Advantage Fund actually went down by 3.91%. Ouch. In comparison, the S&P 500, which is a common benchmark, only went down 1.97%. So this fund didn't do as well as just investing in the overall market. The managers said that equity markets were unsteady, so they changed what the fund invested in throughout the period, trying to be defensive when things looked risky. Okay, so the last 6 months weren't great, but what about the long run? Here we can see how a $10,000 investment would have grown since June of 2015. It started at $10,000 and ended at about $15,926 March of 2025. The S&P 500, however, would have turned that $10,000 to more than $31,000, so that gives some context. Looking at the average annual returns, over the last 5 years, the fund returned 5.3% per year, and since inception, which was in June of 2015, 4.85% per year, compared to the S&P 500, which returned 18.49% and 12.45% for the same periods. The managers want you to know that past performance doesn't mean future success, and these numbers don't include any taxes you would have to pay. Here are some quick numbers. The fund manages about $9.3 million. The advisory fee was about $72,531. It looks like they traded a lot with a portfolio turnover of 77%, meaning they practically changed all the investments 7 times over. The fund was mostly invested in other stocks, about 54%, and companies represented in the S&P 500 index with about 40%. Here are some of the biggest investments. Almost 30% was in AQR Equity Market Neutral Fund. Another 25% in AQR Long Short Equity Fund. They had almost 16% in Vanguard S&P 500 ETF. They're saying there were no big changes in how the fund was run during this time. Now let's check out the Spectrum Low Volatility Fund. We will do the same run through, starting with the fees. Again, let's see how much it costs to manage your money. For every $10,000, it was $120. That's an annual rate of 2.422%. What about the performance? This fund went down 0.61% during those 6 months. The Morningstar LSTI US Leveraged Loan 100 Total Return Index, which is what they compare the fund to, went up 2.94%. So again, this fund didn't do as well, but they said that concerns about inflation and treasury yields affected their investments, so they changed what they were holding throughout the period. So how would you have done if you invested $10,000 a long time ago? In March of 2015, it would have started at $10,000, and it would have been about $1,890.67 by March of 2025. The index it compares to would have turned $10,000 into $15,721. Looking at the averages over the last 5 years, it has done 6.66% per year, and over the last 10 years, 6.61% per year. And they also want you to know that past performance isn't a guarantee and taxes aren't included. They also want you to know that Morningstar isn't responsible for the fund's performance. Some quick numbers. The fund manages almost $192 million. They paid out over $2 million in advisor fees. Their portfolio turnover was 292%. Most of the fund was in cash management. about 66%, bonds at 45%, and market neutral investments at about 16%. What were their biggest investments? About 16% in United States Treasury bills, about 15% in Fidelity government portfolio, and 13% in another United States Treasury bill. They're claiming no big changes during this period. Last up is the Spectrum Unconstrained Fund, so let's see how they did. How much did this one cost you? For every $10,000, it cost $23. That's an annual rate of 2.47%. What about the performance? It returned 91% from October of 2024 to March of 2025. Its main comparison, the Morningstar LST US Leveraged Loan Total Return Index, returned 2.94%. The managers are saying that rising interest rates negatively affected longer-term bonds, which had a negative effect. They are trying to move to floating rate funds. How would you have done since this fund started? Well, if you invested $10,000 in April of 2021, it would be about $10,938 in March of 2025. The Morningstar LST US Leveraged Loan 100 Index would have turned $10,000 into 12,500 yats. Would $20,000 into $12,538? Looking at the averages, it has returned 2.29% per year since April of 2021. They also want you to know that past performance is not a good predictor and the numbers don't include taxes. Some quick stats. This fund manages about $6.1 million. They paid out almost $78,000 in advisor fees. The portfolio turnover was 194%. The biggest investments were mostly in bonds and cash management. The top holdings included about 22% in Holbrook Structured Income Fund, 18% in United States Treasury Bill, and 18% in PIMSO Income Fund Institutional Class. They are also claiming there were no big changes in how the fund was run in this time period. Alright, so what does all of this mean? The Spectrum funds seem to be underperforming their benchmarks. The Active Advantage Fund is the most concerning as it's consistently trailing the S&P 500. The managers keep changing things up, but it doesn't seem to be making much of a difference. The Low Volatility Fund might be a safer bet, but its fees are pretty high. That's something to keep in mind. The Unconstrained Fund is newer, so it's hard to say for sure. Its returns have been okay, but it's also taken on a lot of risk with leveraged positions. Overall, I'd say these funds aren't knocking it out of the park. There are probably better options out there if you're looking for growth, but you really need to do your research and decide based on your personal investment goals. Alright, that's our breakdown of this semi-annual shareholder report. What's your take on these funds and their performance? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.